Have you ever found the perfect property, your dream deal, only to hit a wall when it came to the funding? That moment of frustration is where many journeys begin. Welcome to Real Estate Capital and Growth USA. Today, we pull back the curtain on the pivotal question every ambitious investor faces: how do you unlock capital? But before we begin, a critical disclaimer: this video is for informational and educational purposes only. It documents investor experiences and is not financial, legal, or tax advice. The results you will hear are unique to their situations and are not guarantees. You must consult with qualified, licensed professionals before making any financial decisions. Real estate investing involves risk, including the potential loss of capital. In this episode, we navigate the journeys of real U.S. investors who faced this funding challenge. We'll be looking at a concept often discussed in investing circles: the use of multiple credit lines, sometimes called credit stacking. To truly understand their stories, let's first set the stage by defining the broader landscape of real estate funding. Defining the landscape. In real estate investing USA, funding represents the backbone of every project, whether it involves acquiring a residential property in Dallas, financing a commercial building in New York, or renovating a suburban duplex in Chicago. Investors constantly explore strategies such as conventional mortgages, private equity participation, and short-term capital solutions to secure opportunities. Yet, despite this variety, many find themselves facing closed doors. Strict qualification processes and limited flexibility often leave ambitious investors searching for alternatives. This is where the concept of credit stacking in the USA begins to surface, presenting itself as a structured yet demanding approach to funding. With that stage set, let's step into the broader landscape before diving into practical stories. In the U.S. property funding ecosystem, capital can flow through traditional bank loans, mortgage-backed securities, or community-driven real estate syndications. Each avenue reflects a particular investor profile. Some prioritize stability, others flexibility, and some prefer short-term liquidity. However, many discover that entry barriers such as high credit score requirements, collateral demands, or regional lending restrictions can narrow their options significantly. Faced with these barriers, some U.S. investors explore credit stacking strategies. This approach does not mean a single lender provides all capital. Instead, it involves strategically opening and managing several credit lines across institutions. For disciplined investors, it can create a structured network of available funds that enable property acquisition or renovation. Yet, it also requires strong organizational capacity, precise timing, and constant monitoring to avoid pitfalls. Within the U.S. context, especially in high-demand states like California, Florida, and Texas, this method becomes part of broader conversations about alternative capital structures. It highlights how creativity and discipline merge to unlock possibilities where conventional doors remain closed. Yet, as every professional emphasizes, this path is not simple. It requires patience, consistent organization, and strategic planning rather than shortcuts. As we close this section, one truth stands clear: real estate funding in the USA is not one-size-fits-all. Conventional loans, credit stacking, and partnerships are all tools within a wider toolbox. For some investors, these tools open doors. For others, they highlight the complexity of capital markets. The lesson here is not about chasing shortcuts but about understanding the framework that shapes opportunity. In real estate investing, clarity of method often becomes just as critical as access to capital itself. Story number 1: the fix and flip investor in Texas. In real estate investing USA, one of the most dynamic markets for property funding strategies remains Texas, a state known for rapid population growth, diverse housing demand, and competitive investment opportunities. Within this environment, Fix and flip projects often attract ambitious investors seeking to transform distressed assets into market-ready homes. Meet Alex, an investor navigating this exact challenge in Dallas, Texas. He discovered a distressed property with strong potential but lacked the immediate capital for acquisition and renovation. His journey highlights how strategic use of multiple credit facilities, sometimes called credit stacking USA, can provide a pathway forward. And now, with that foundation established, let's explore the story step by step. Alex's first step was identifying the property itself. In the Texas housing market, distressed homes often carry lower purchase prices, but require significant capital to bring them up to livable standards. Instead of relying on a traditional mortgage, Alex explored a business line of credit to finance the acquisition. This approach allowed him to move quickly, in a competitive environment where hesitation often means losing the deal. Once the property was secured, the renovation presented the next challenge. Instead of drawing from the same credit line, Alex turned to a shorter-term credit facility specifically designed to cover improvement costs. This layered structure reflected the Capital Growth USA approach, where disciplined investors separate acquisition and renovation funding to maintain clarity in financial tracking. His focus was not simply on accessing money, but on aligning the funding with each stage of the project. For Alex, the real challenge was not borrowing, it was managing. Every credit draw, repayment, and renovation deadline required precision. In the world of Property Funding Strategies USA, organizational discipline often makes the difference between a successful flip and a stalled project. His experience illustrates that while funding opens doors, project execution and record-keeping are what keep those doors from closing prematurely. Alex's Fix and Flip in Texas demonstrates a critical truth: real estate investing USA requires more than just capital access. The strategy of structuring funding, whether through a business line of credit or short-term renovation financing, must be balanced with careful execution. His story is less about quick results and more about discipline, planning, and adaptability. In competitive markets like Texas, success often comes not from one bold move, but from consistently managing each step with clarity and precision. Story 2: The Portfolio Builder in California. In real estate investing USA, few markets capture global attention quite like California. With its vast population, high housing demand, and diverse property landscapes, building a portfolio here requires vision and resilience. Now, let's shift to Maria, a California-based investor. Unlike Alex in Texas, Maria's journey was not about a single flip, but about building a long-term rental portfolio in California. From the start, her approach emphasized patience, strategic credit management, and disciplined scaling. Traditional financing quickly met its limits. To move forward, Maria pursued an alternative path. Over several years, she established credit for her business entities, blending property equity with business credit lines to fund future acquisitions. With that foundation in place, let's walk through Maria's multi-year story. Maria's first challenge came when her initial property loans reached their cap. In a state as competitive as California, rental investors often face tighter restrictions. To continue, Maria separated her personal and business credit. Establishing Business Credit Score, Real Estate Investors USA gave her company's credibility and opened the door to funding opportunities not tied solely to her name. Her strategy then expanded into leveraging equity. Once a property stabilized with tenants, Maria used its rental income and accumulated equity, in tandem with business credit lines, to fund the next purchase. This system allowed her to scale gradually, while keeping each acquisition linked to both credit access and property performance. Over 5 years, Maria's discipline and persistence transformed her portfolio. By combining business credit cards for Real Estate USA, property equity, and strategic planning, she built a system capable of steady expansion. Her experience underscores that portfolio growth is rarely about speed. It is about resilience, tracking, and aligning credit structures with long-term vision. Maria's California story illustrates that real estate investing USA is not just about one deal, it's about creating systems for growth. By leveraging business credit for real estate, property equity, and patience, she scaled deliberately in one of the most competitive housing markets in the United States. Her path shows that persistence, organization, and time can be as powerful as capital itself. In California, as in other U.S. markets, disciplined scaling often wins over quick, risky gains. Analyzing common themes. Analyzing real estate investing strategies in the USA requires not just isolated stories, but the ability to see patterns across multiple investor journeys. In this segment, we compare the experiences of Alex and Maria, two very different investors whose approaches revealed shared elements that every observer can learn from. By placing their strategies side by side, a deeper educational picture emerges. These themes are not prescriptive but descriptive patterns that reflect discipline, documentation, and reliance on structured methods. Certain investors in California, Texas, and New York have found that these elements often reappear, regardless of whether they focus on flips, rentals, or long-term portfolio building. This exploration sets the stage for identifying what remains consistent in the diverse world of real estate investing in the USA. The first shared theme was credit discipline. Both Alex and Maria emphasized the condition of their personal and business credit profiles, treating credit health as a foundation for long-term growth. In real estate investing across the USA, maintaining a reliable credit history is not about fast rewards but about building credibility with financial institutions. While outcomes vary, their stories highlight that structured borrowing often begins with consistent record-keeping and patience. Another common element was documentation. Alex and Maria both maintained meticulous records. Documentation was never an afterthought but a constant practice. In the real estate markets of cities like Los Angeles and Dallas, investors often stress that consistent record-keeping not only prevents mistakes, but also allows for faster responses to opportunities. These cases illustrate how documentation can transform complexity into clarity, especially when managing multiple properties. Finally, both stories revealed the importance of professional guidance. While their journeys remained unique, each relied on expert advisors such as accountants and legal professionals to ensure clarity in structuring their portfolios. In U.S. markets, this reflects a recurring pattern. Many investors choose to consult professionals not for immediate returns, but to reduce uncertainty and plan more effectively. While no two journeys are the same, resilience combined with professional input often defines sustainable growth. Taken together, Alex and Maria's experiences highlight that successful real estate investing in the USA often hinges less on luck and more on consistency. Their journeys show that credit discipline, organized documentation, and professional collaboration form a repeating framework across different strategies. While the methods and pace varied, the underlying principles remained consistent: cautious growth, structured records, and resilience in adapting to challenges. These themes provide an educational framework for observers, not a formula, but a set of recurring signals found in real-world cases. The crucial how to think about this framework. In real estate investing in the USA, one of the most overlooked lessons is not what investors do, but how they think. When reviewing stories like Alex in Texas or Maria in California, it's tempting to copy their steps. Yet the true value comes from understanding the mental framework that allows investors to adapt, adjust, and make informed decisions. This framework isn't about quick wins or promises of success, it's about education, preparation, and clarity. Certain investors highlight that the journey begins by strengthening financial literacy, surrounding yourself with trusted advisors, and performing an honest self-assessment before moving forward. This is where the how to think about this framework becomes not only crucial but timeless. The first principle emphasized by many U.S. investors is broad financial literacy. Instead of memorizing someone else's strategy, they focus on core concepts, debt-to-income ratios, how credit scores work, and the basics of leverage. These fundamentals allow them to analyze opportunities in Los Angeles or Dallas with confidence. Without this foundation, strategies become guesswork. With it, decisions gain clarity and resilience. The second principle is team building. Certain investors describe how they interview certified professionals, such as CPAs or attorneys, not to outsource responsibility, but to create a circle of expertise. In markets across New York or San Francisco, having a professional team ensures that each decision is cross-checked, reducing uncertainty. The framework here is not about doing everything alone but about knowing who to trust for specialized guidance. The third principle is self-audit. Before pursuing new credit or acquisitions, certain investors pause to assess their own financial position. They examine cash flow, obligations, and backup strategies to ensure they are not overextended. This reflective process, often overlooked, creates discipline. Whether in suburban neighborhoods of Florida or urban markets of Chicago, this practice allows investors to move carefully, guided by reality rather than assumption. The how to think about this framework is not about copying someone else's success story. It's about cultivating the mindset that allows you to hold meaningful conversations with professionals, evaluate risks clearly, and move forward with awareness. In real estate investing across the USA, this way of thinking proves more durable than any single tactic. The ultimate takeaway is not to replicate Alex or Maria, but to recognize recurring patterns of literacy, teamwork, and self-assessment. This framework doesn't eliminate risk, but it gives structure to uncertainty, creating room for resilience. Today we explored Alex's short-term fix and flip in Texas, and Maria's long-term portfolio growth in California. Though their methods differed, both journeys highlighted complexity, discipline, and professional collaboration. Stepping back, what unites their stories is not a secret formula, but a framework for thinking, where financial literacy, careful record-keeping, and trusted professional input intersect. Certain investors in the USA approach opportunities this way, to navigate uncertainty with greater clarity. And to be absolutely clear, these are documented stories, not a roadmap. Your path is uniquely yours, and only qualified professionals can provide guidance tailored to your situation. If you found these U.S. real estate credit stacking stories informative, remember that education is the foundation. This documentary-style series is designed to bring real-world insights into how investors think, prepare, and adapt, not to recommend specific steps. Learning from diverse case studies helps build perspective, which is the most durable tool in a complex marketplace. Warning disclaimer reminder, this content is purely informational and educational. It is not financial advice. Always consult licensed professionals before making investment decisions.